Hello, it's Kim Butler. I thought I would do a similar video with an age 70, still is a female. Still want to look at this for 30 years or 31 in my example, because a 70-year-old piece of cake lived to age 100 if they were healthy. And again, we want to be measuring whole life over the long run. So you can see in this funding calculator from Truth Concepts software that the rate of return on the growth of the cash value, so this green and blue line is the growth of the cash value over our 31-year period of time, is right around the 3% mark. And that's what we call an internal rate of return. It means after all of the costs have been paid. If you're thinking about it like real estate, it's the net growth rate of the cash value. After the cost of the death benefit, after the cost of running the mutual company, and after the cost of any commissions that have been paid in the past. And so kind of nice to know. For a 70-year-old, you've got a 3% rate of return. Now, it actually is a little bit higher than that because that net rate is kind of hard to compare out in the marketplace. There really isn't anything that would do that other than whole life insurance by itself. Because whole life insurance has a death benefit included, even if your focus is mostly the cash, we still have to account for that death benefit. So even on a 70-year-old, this is of course assuming the person's healthy, if we include term insurance and we just say we're going to keep it for 20 years, that rate jumps up to about 4.8%. Now you'll notice here in the middle that the accounts that are just like a regular savings account do get ahead of it a little bit of the time. But over that long period of time, while the cash value and the death benefit equal up here on the right, so this dark green line is death benefit, the lighter green line is the cash value, all these other lines are just various accounts at various interest rates. But our 4.8% over time is a per year rate of return. And if we really want to look at it accurately, we need to add in essentially what that death benefit is providing in terms of costs. So if we include term insurance, we see that the rate, I must have had the term insurance on already. So right, the 3% was before the term insurance. The 4.8 is after we've added the term insurance. And then there's, and again, not that you're going to buy term insurance, but the adding of that term insurance button gives us a value worth 1.8% in this example of the cost of that death benefit. And the death benefit's already included. So this is just a way to measure it. So 3.0% of just cash growing, the equivalent of 4.8% right here, if we acknowledge there's a value to the death benefit. And then one more thing, if we acknowledge that we are not taxed on the growth of the cash value of life insurance, and yet any of our other liquid accounts like a savings account would be taxed, then we're up to the equivalent of a 6.3% rate. Doesn't mean that the life insurance is growing at that, but if you incorporate the death benefit and you incorporate the fact that it's not taxed, the value of those things are getting you to a 6.3%. So again, this is on a 70-year-old, kind of interesting. Hope it's helpful. Reach out to me if you have questions. My best summary of the life insurance is a book called Live Your Life Insurance. It's on Amazon. You can get a Kindle, a soft copy, or an Audible version if that's how you prefer to learn instead. Thanks for joining us today. Enjoy.